Hello and welcome back, traders. In today's market analysis, we're diving deep into the Nifty 50 daily chart. The index closed almost flat today, down a slight 0.23%, but don't let that boredom fool you. The price action has set up a potentially powerful trade for tomorrow, and it's a classic example of a concept we love, the Fair Value Gap, or FVG. Let's get into it. First, let's zoom out and understand where we are. The Nifty has been in a strong, sustained uptrend for the better part of a year, as you can see from this massive rally from the 21,500 zone. However, recently, the momentum has slowed. We've entered a phase of consolidation, roughly between 24,500 and 25,250. This is a healthy breather after such a strong move. The key for us as traders is to identify within this range where the next leg is likely to go. And today's price action, combined with the recent FVG, gives us a strong clue. Now, let's focus on the educational gem on this chart. Look at this sharp drop we had back here in early September. This fast, impulsive move down created what we call a bearish fair value gap. An FVG is essentially an imbalance in the market, a zone where price moved so fast that it left a gap of unfilled orders. For a bearish FVG, it's a zone of potential resistance on the way back up. The theory is simple. Price drops fast, creates the FVG. Then, when price rallies back up to fill that FVG, it often finds sellers and reverses. And look what happened just now. Over the last few sessions, price has rallied precisely into this old bearish FVG, filled it. And today, we see a rejection. The market is giving us a textbook signal. It filled the imbalance and is showing signs of rejection right at a key resistance zone. So, what does this mean for tomorrow? Let's outline a clear, actionable plan. The bearish FVG zone and today's high around 24,894 are our primary resistance. For bearish entry, we need confirmation. A break and close below today's low or a break below the key support level at 24,700 se 24,750 could be our trigger to enter short trade. This confirms that the sellers from the FVG are in control. On-screen graphic shows resistance at 24,894 and the trigger zone below 24,750. If we get this bearish confirmation, our first major target is the 24,500 level. This is the strong support base of our entire consolidation range. A break below 24,500 opens the door for a much deeper move towards 24,250 or even 24,000. Now, trading is about managing risk, not just reward. Our entire bearish thesis is invalidated if price does the opposite. If the Nifty moves up and sustains above 24,900, especially if it closes above 25,000, it means the buyers have absorbed all the selling pressure from the FVG. In that case, the next stop could be a retest of the 25,250 highs. We do not want to be short if that happens. On-screen graphic shows the invalidation level at 24,900 se 25,000. Let's do a quick recap. The setup. A classic bearish FVG fill and rejection. But the trigger. A break below 24,750 for potential short. The target. 24,500 initially. The stop loss. A move above 24,900 invalidates the setup. Always remember to position size correctly and manage your risk. This is a daily chart setup, so it requires patience. And that's our analysis for tomorrow. I hope this was educational and helped you understand how to spot and trade these FVG setups. If you found this useful, smash that like button, subscribe for more daily technical breakdowns, and let me know in the comments what you're watching for tomorrow's session. Until next time, trade safe and trade smart.